Thank you once again for joining me on this particular recording for your financial reporting class. Today I want to focus on leases, and the standard that deals with leases is IFRS 16. Standard stipulates the principles, recognition, measurement, presentation, and disclosure of lease contracts. It's very important for us to see that a lease is an agreement whereby the lessor conveys to the lessee the right to use an asset for an agreed period of time in exchange for consideration. Now, it's very important for us to know that leases do not deal with exploration or usage of minerals, biological assets, or intellectual property licenses. Why? Because these fall under the respective standards. Now, the spirit of IFRS 16 is to discourage the distinction of operating and finance lease, so that the only leases to be treated as short-term leases or operating leases are those that do not exceed 12 months or those that involve low-value items. And of course, the examples have been given there. For low-value items, you have got leases involving computers, office furniture, phones, what have you. So for the above transactions, a firm can amortize the lease obligation on a straight line basis. Right. At the contract inception, and of course leases are normally examined from the lessee's point of view. You see, in a lease there are two parties, the lessee and the lessor, or the lessor and the lessee. The lessor is the legal owner of the asset, and the lessee is the user or the commercial owner of the asset, so to speak. Now, the entity should assess whether the contract contains lease or not. Now, how do we know that a contract retains a lease? A contract is or contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for payment, in exchange for consideration. So in this case, we need to remember the framework's definition of an asset. An asset is a resource controlled. Control is conveyed from the lessor to the lessee when the customer, who is the lessee, has both the right to direct the usage of the asset or to obtain substantially all the economic benefits from that asset. Now, control or rights might be absent where the supplier has got what we call substitutional rights relating to an asset. If the supplier, for instance, of a leased asset can withdraw the asset at will at any time and replace it with a different one, then we can argue that control has not passed on from the lessor to the lessee. All right, now let us not forget the key point. Classification of leases is now highly discouraged. Operating and finance lease should be treated in the same way, except for the two exemptional items mentioned. Low-value items, low-value leases, and leases that do not span for more than 12 months. At commencement of contract, lease recognizes, or lessee rather, recognizes the right of use asset as well as the associated lease liabilities, so that in a lease arrangement we see that there must be an increase in the assets of the lessee as well as obligations related to the payment of lease liability. At your own time, I'd like you to write how we measure right of use asset and lease liability. I'd like to progress to accounting for leases, of course, subsequent treatment. The right of use asset after initial recognition should be depreciated in the books of the lessee. And of course, you have got the double entry there. Use I-16 if you're going to treat the asset as property, plant, and equipment. Use fair value model if you're going to treat the asset as an investment property. If the asset is revalued, revert to IS 16. And if there's impairment on the asset, you can revert to IS 36. Subsequent accounting treatment. The lease liability must be, accounted for, amortized over, the lease term, and of course, that will give rise to issues to deal with interest. So if there's interest to be calculated, please, which is most likely to be the case, you debit profit or loss and credit lease liability, and when you make that installment payment, you debit lease liability and credit bank. Okay, let us look at the leaser's books. The leaser is the legal owner of the asset. We must first ascertain whether a lease is a finance or operating lease. Finance leases, of course, substantially transfer all risks and rewards of ownership of the asset to the commercial owner, who is the lessee. A finance lease, again, I want you to take some bit of time to read through those points. That is just textbook knowledge. Now let us discuss the important bit. If we are certain, if we as the lessors are certain that this lease is a finance lease, then we should debit record fixed payments related to, the lease, all the amounts that we shall receive from our customer, variable payments. Of course, we might be engaged in, let's say, servicing the asset from time to time. Residual value guarantees, of course, we expect the assets to be at a certain value after the end of the lease contract. If that value is not achieved, then there must be payments from our customer. Exercise price, the customer buys the asset, we may charge them something. Penalty charges, if the customer defaults on their obligations, then we might have to account for that. Now, it is very important to note that all these payments will be future payments, and so discounting is very important here. All right, lease payments, and this is a critical point, should be split between lease income, that is a capital repayment, and lease finance receivable, which is interest. I hope that you can see that. Now, debit cash when you receive the amount, credit lease receivable, all right, and what else do you have? I think I have done, I need to correct that. Let me just change that a bit. Push this one here. We do that. Capital repayment is that one, and the interest, of course, should be that one there. Okay, so please, the journal is there to be seen. Whenever we receive payment as legal owners of the asset, we debit cash with the full amount received, credit lease receivable to reduce how much the customer owes us, and then credit lease income, all right, to recognize income, the return on the assets. I hope that you can see that. All right, let's progress. If the lease is an operating lease, things are very simple. We proceed as follows. In the leaser's books, debit bank and credit lease revenue on a systematic basis, preferably on a straight line. Okay, sale and leaseback. Under sale and leaseback arrangement, the key question is the sale recognized under IFRS 15. Again, you see, a repurchase agreement is where an entity sells an asset but retains the right to repurchase the assets. This is often not recognized as a sale, but as a secured loan against the asset. Indications that this is not to be recognized as sale may include the following points, which I think you can write and, of course, ask questions. Thank you very much for your listenership. I want you to get back to me with questions. I think now we need to get on to an example so that we can prepare our minds for what is to come. A machine is delivered on the first day of the accounting year. This is an example under leases, and I am coming from the background of IS 17 because I feel that it is very important to know the transition. A machine is delivered on the first day of the accounting year, valued at $1.7. Lease contract requires annual payments of $400,000 for the next 6 years. The machine has a useful life of about 7 years. The lease arrangement transfers legal title of the asset to the lessee at the end of the lease contract. The interest implicit in the deal is given below. So you're required to prepare extracts from the statement of profit or loss and the statement of financial position for the year ended, assuming, of course, that the installments are paid in arrears or advance, of course, at those rates. So let us try to have a go at this question again. You can take time to write this question so that as I begin to explain, you are with me, you are able to counter check with what you have done. Writing is part of learning. Writing, typing is a crucial part of learning. So I get on to my work. Now we saw that in the question, not that one, but the one in word, we saw that in the question we have got fair value of the asset at 1.7, and of course the minimum lease payments, ignoring discounting, will be 400,000 multiplied by 6, which is 2.4. So the standard I-17 gave us, guidance is that we have to go for the lower of the two, which is between 1.7 and 2.4. The lower of the two is 1.7, of course. So we begin to run, and we've got that, okay? And then here we say this much multiplied by 10%, 10.84%. I hope that you can see that. And then here we say this plus the opening balance plus the interest. You've got that figure. And then here you say 400 actually minus 400. I hope that you can see that. And then closing balance therefore will be the difference between that and that. So now the problem that I have there is I've already got that figure, which is a negative, so I just have to add 2 in Excel so that I can get the right answer. The opening balance for year 2, and this is where the secret is the closing balance for year 1. So I hope that you can see that. Okay, so of course we can replicate the formula, and then of course here also we can write we can do the necessary 400 can come out there. Let me just delete the ones that are not necessary. I think starting from somewhere there, let's just clear content. I hope that you can see that. I think even this one is not necessary. Okay, so that in my Excel, I'm using the power of Excel, and of course it works for me. If you understood the first line, how I did it, and the fact that the closing balance for year 1 is the opening balance for year 2, that makes a whole lot of a difference. Okay, I hope that you can see that. I'm just using the power of Excel here. So again, here we can always have the following. So let's begin to populate. Closing balance for year 2 is opening balance for year 3. I put those figures. Again, you do the same. You'll be doing same, and I think for SCCA guys, I think this should be something that is not very difficult for you to apprehend, for you to understand. Okay, so I hope you can see that at the end of my working, the end of my table, I've got a 0. We have amortized lease obligation in this case. Okay, so the focus of course is on the lease obligations arising. Right? Great. Let us see if we can now do the extracts. So for my extracts, I'd like to start with the profit or loss, and of course I'll start with the depreciation. Let me just pick one of those figures and push them somewhere here so that as I do the work you're able to see there. So depreciation based on the 7 years because of the fact that there's an option to purchase. I hope that you saw this. Okay, I hope that you saw that, right? I hope that you saw that line. All right, So we're going to run with 7 years for depreciation. So say 17 divided by 7 years, which of course gives us, I think those mathematicians know better than I do. That's a figure there. Finance cost has already been worked out. Go to your first year. Remember, the question says first year. All right. If I may go to the question, it says prepare extract from the statement of profit or loss and the statement of financial position for year 1, assuming that the installments are paid in. So please check that one. So go back to my first year, my installment in this case. Let me just escape from that one. I think you can see that figure there. That's the figure there. All right. So let's go and pick it again. We pick it just the way it is. That's the figure there. All right. For our balance sheet, we need the CV of the assets. So all we need to do is to say 17 minus 243. We close off. I hope that you can see there what you have there. Got 1457. And then next, for our lease obligation long term, I want to just tell the provision closing balance for the following year. It's as simple as that. Following year in this case is year 2. So what's the closing balance? Just go and get it, pick it the way it is. The closing balance for year 2, of course, is 1245, 1,245,000. Therefore, the current liability will be the same one, not that amount, but the difference rather between closing balance for year 1 and the closing balance for year 2. Remember that the total obligation at the end of year 1 will be that much. So for us to find the current liability, we have to remove only the non-current liability. Let's do the work. We say 1484. Okay, 1484 minus 1245, if I'm not mistaken. How much do we have? 1484 minus 1245. How much do we have? I've got a 239. So I hope that you've gotten something. And this is lease in arrears. Let us now turn to the next one, which is lease in advance. And I'll have to do it again. 17 is our starting figure. The installment should come first because you're paying on the first day of the year. I hope that you can see that one. The balance in this case, of course, will be the difference. So what we can do is we say this figure plus that figure, because I'm already in Excel, there's a negative already there. And then we apply the rate of interest on this figure, say that by 16. Remember, we have always to add that 32. Okay, supposed to say point. Okay, supposed to say point. All right, supposed to say 0.6. All right, so say point. Now let me just do something here. Correct it. 0.632. Okay, that's what I have there. And so we always have to add our interest, so we do the necessary. Okay, great. So let me just give you those. Remember, the installment does not change, and then again I think here will not have a big problem. I'm just running with the formula. Again here you don't need to have a big problem, and also here we don't need to have a big problem. So every time we put the opening balance, things must be working themselves out. The closing balance for last year, year 1, is the opening balance for this year. All right, you do the same here. Closing balance for second year is the opening balance for that. Continue like that. Closing balance, you continue like that, and I think this will be the last thing that I do here, so that when we discuss next time, we'll be doing some other questions from Kaplan. So finally, we do that. I hope you can see again by the time we reach year 6 that we've got 0. We have fully amortized the obligation. Alright, so again, let us deal with the extracts. I don't think that we are going to have a big difference in terms of what we have in the other, working, except of course for except of course for the non-current liabilities and current liability section. So let's begin. We said for our profit or loss, the depreciation will be 17 divided by 7. That is the amount there. For our finance cost in the first year, the finance cost was that much. I think you can get that one, 212. I hope that you're doing something on the other side. Again here, I don't want to waste much time. You remember what we did. The CV of the asset, and I just work that one out. It says 17 minus 243. That's the figure that we have there. And then this one now is a little bit simplified. Our current obligation will be the next installment. In this case, the next installment is the 400 in the following year, which is 400. Therefore, the obligation, non-current obligation, will be the total obligation outstanding 15.2. Hope that you can see a 15.2 somewhere at the end of year 1 minus the same 400. How much are we getting? 1512 actually minus 400. We have got that much. So notice that this is the figure there that you were looking for. That's the figure there. Let me just highlight it for some of us to see. That's the figure that we had. So we got the interest as well as that figure there. All right. So thank you very much for listening. I think video ought not rather to be long. I'd like to end there. Let me hear from you.